All right, good evening, and thank you for joining us this evening. My name is James Monroe. I'm a financial planner here at Oregon Pacific Financial Advisors. We're going to get into our financial management webinar that we do. I call it Financial Literacy 101. Again, my name is James Monroe. I am a financial planner here at Oregon Pacific Financial Advisors. I am also a registered representative offering securities through United Planners Financial Services, who's our registered broker-dealer. And we're going to go ahead and get started this evening. So the objectives of tonight's webinar are first to introduce you to some potential concepts that maybe you haven't heard of, and then educate you on how those might work best for you and some of the information that you need, and then we'll illustrate some numbers on how some of that works. Now, our commitment tonight is to provide you with some very sound financial information. We believe in financial literacy and understanding first what you have and how to move forward. And then second, we'll help you identify some goals for you. And then at the end, we'll be able to offer you a complimentary consultation. Just to note that this presentation is not intended for tax, legal, investment, or retirement advice, and we're not making any recommendations tonight. The recommendations will be made on an individual basis. Tonight's goal is to illustrate some very general concepts and things like that for you. You have a workbook that you got emailed to you when you signed up for the webinar. I'll be referencing it, and a good place to take some notes and write some things down for you to bring to our meeting if we do end up planning one. So 6 steps to financial success. The first one is to protect what you have. We'll talk a little bit about that. Second one is to take control of your cash flow. Third one is to invest wisely. Number 4, to manage your taxes. Number 5, to save for retirement. And then last but not least, leaving a legacy, making sure that your family has the ability to be able to go through the process and not have to deal with the financial stuff, but be able to deal with the emotions. So let's start out with step number 1. So protecting what you have. So there's key areas of insurance that we'll cover tonight. The first one is medical. Medical insurance is very important. It's for the what ifs. The second one is long-term care insurance, the disability insurance, liability insurance, property and casualty insurance, and life insurance. So let's talk first about health insurance. Health insurance plans, depending on if they're private or if they're a group policy, there's different options and different deductibles and costs, and it could be quite overwhelming. And fully understanding what you have and what best meets your needs, I always recommend that you talk to an insurance professional. You can visit healthcare.gov and learn about your options, but even on healthcare.gov, although I'm licensed to sell health insurance and I understand it at a decent level, a lot of it is still pretty confusing. I still personally have a health insurance professional that I go to really find out what the best option is for me and my family and what we need. So we have a few people that we can send to you that work with us very closely in our team and are able to help people, and we trust that they're going to do the right thing 100% of the time. The second thing that we talk about is life insurance. So life insurance is really just a tool. It's a vehicle to financially help your family, whether you live too long or whether you die too soon. But there's 3 real questions that you've asked. How much do I need? So my question is, what do you want it to cover? So in your workbook, there's a page that talks about doing a life insurance assessment. What things do you want it to cover? Do you have debts? Do you have car loan debts, credit card debts? Are there personal loans out there that you need to cover? Is there an income that would need to be replaced? Do you have young children? If you do, how does Social Security play into that? We could work through some of that. Is there a mortgage that needs to be replaced? Is there education that we want to take care of for the kids? Is there some sort of charity that we want to leave money to? Things like that. But what do you need? What do you need it to cover? How much do you need? Second question is, what type of policy do you want? So there's 2 basic kinds of insurance. There's term and there's permanent. But there's 7 different flavors on the basic side and then a whole bunch of different ways to do those. So again, sitting down with a professional like myself that is independent, that can offer every type of insurance from every company that's out there in the marketplace and really find the best thing for you. And then the third real critical question with life insurance is, who gets the money? If you have young children, again, who's going to take care of the children? How is that going to be set up? And we'll talk about this and leave it in a legacy, but how do you want to leave it to the children? How do you want to leave it to the kids? How do you want to leave it to your family? Do you want a trust entity to take care of it? And we'll go through that. But who gets the money? That's a real critical question. If you already have life insurance, when was the last time that you reviewed and updated your beneficiaries? I sit down with a lot of clients. I was talking to somebody the other day, and their beneficiaries on their life insurance were the people that were going to take care of their kids when their kids were young. Well, their kids are now 19 and 21. So now who gets the money? Now who gets to take care of that? Do they want it to go to the kids, or do they still want it to go to the same people? Group coverage may not be sufficient. So there's a lot of insurance policies that get offered at work. There's disability policies, there's short-term, long-term disability stuff, there's cancer policies, there's life insurance, there's health insurance, there's all kinds of things that potentially could be offered to you through your job at work. But is it enough? Is it sufficient for what you want it to cover? Again, the term insurance is the transfer of financial risk. So we're transferring the financial risk from you to the insurance company to take care of what arises and what comes up. So is the coverage sufficient? That's something that you should review with a professional, and something that we can definitely help you out with. So moving on to step number 2, taking control of your cash flow. So let's pretend that you're going to invest in a company. So let's pretend you're on Shark Tank, and they find out in Shark Tank that you have accounting problems. So they cannot account for 20% of their cash flow. They're spending money and they have no idea where it's going. There's regular unexpected expenses. So what does that mean? That means that stuff pops up all the time. There's always a problem. There's always something that happens. There's always some sort of large unexpected charge that gets charged to it. And then routinely delaying filing statements and tax returns. It's routinely late on stuff, and the accounting process isn't done properly, and it's not done in a timely manner. Let me ask you, if you were a shark and you had $1 billion and they wanted $1 million for your portion of this company, is this something that you would invest in? I would personally say no, this isn't something that I would invest in. But when I've sat down with clients, I've found that a lot of this stuff to be true. So one of the biggest things that we like to teach is budgeting and learning how to tell your money where to go and what to do before you actually need to use it. Planning for that stuff ahead of time. Being able to account for those discretionary expenses that you're spending. Trying to plan for those regular unexpected expenses. So if they're regular and they're unexpected, they now become expected. So maybe planning every 6 months if you have a medical expense, or if you have an auto expense, or if you have something like that. And then not filing extensions every single year for your taxes, but getting that stuff done on time, preparing for it, planning for it, having forward thinking, preparing, not reacting in the sense. A lot of clients I sit down with, they sort of have some of these challenges where they're not budgeted. They don't know how much money they spend. That's something that we work through, and something that I could help them with, and give people the right tools to be able to help with that stuff. And then making sure that they're planning for their taxes properly, either if they're on W-2, making sure they have enough money taken out. If they're 1099 or if they own their own business, making sure that we're forward planning with their CPA and with their tax professional they're currently working with. So one of the things that we would do is assess the current financial situation that somebody's in, help somebody build a cash reserve. It's said that if we talked about certain things, having $1,000 saved would help eliminate a lot of those unexpected expenses, having to put it on a credit card. And then really paying down your credit card and paying down that debt, getting rid of that debt that's costing you a lot of money. Some traditional savings vehicles, obviously savings accounts at the bank, things that are going to earn you 0.01%. There's things called certificates of deposit, or what you may know as CDs. Money market funds, those are all cash style traditional savings vehicles. And let's talk about the credit card. Let's talk about the $160,000 credit card. So this is a case that happens a lot of the times when I sit down with somebody. So let's say you had credit card debt. You had $30,000 in credit card debt. The national average right now is about $11,000 in credit card debt. Let's say that credit card at $30,000 was going to charge you 18% in interest. You're making $541 a month payments. Over the course of 10 years on $30,000, you would actually pay $64,867. That's a lot. And it's because the interest is working against you. If you had an investment, and in this case, we're illustrating a stock investment, and you were saving $541 a month, and you were earning 8%, in 10 years, just with easy math and using the rule of 72 and using compound interest, that would actually turn into $99,634. That's a $164,000 difference. I'll say it again. It's a $164,000 difference. So where would you rather be? Would you rather be positive $99,000, or would you rather have to pay out $64,000 to get rid of that credit card? One of the things that we'll do is we'll help you and give you the tools to help pay down that credit card debt a whole lot faster. So moving on to step number 3, let's talk about investing wisely. So we have Mr. and Mrs. Taylor. Mr. and Mrs. Taylor are currently 50 years old. They have a $1 million portfolio. only in one type of investment. They did not protect against any investment risk. So I see this a lot with clients where working with somebody and they have a 401k. Inside their 401k, they have their entire nest egg. But it's invested in maybe one type of a fund or one sector of the market. And what ends up happening is if we have a bear market, so if we think about 2008, 2009, where the S&P 500 lost about 50%, their $1 million actually turns into $500,000. So let's say they were going to retire a year before that, or let's say they were planning on retiring within that next year. So I have clients that, in 2007, they were planning on retiring in 2010 or 2011. They ended up having to work for a few more years because their portfolio went down quite a bit. Their portfolio went down to half. I always tell my clients that investing in the market, it's more time in the market and not timing of the market. So being a little bit more aggressive potentially when you have longer periods of time to be inside the market, that we have time for recovery. We have time for that market to bounce back and recover. So some lessons that the Taylors learned. Diversifying those investments. So by diversifying those, we're spreading out that risk across a couple different sectors and a couple different types of investments. Assessing their risk tolerance, really actually having a conversation, finding out how they feel about that, and then managing their portfolio. Working with a registered investment advisory firm is very important because we have your best interest in mind. We work as fiduciaries to make sure that we're managing that portfolio based off what your goals are, based off what's in the best interest for you, and working through that process. So a couple types of pooled investments. We talk about mutual funds and ETFs. Mutual funds and exchange traded funds are sold by prospectus, which means that it's very detailed in there on how that money's invested. And we want to make sure that we consider the investment objectives, risks, charges, expenses very, very carefully, and make sure that everybody understands what they're getting into and understands what types of investments they have before they invest their money. So why do people invest in those mutual funds and ETFs? Well, the convenience. They have a convenience of being able to get into certain types of investments without having to have a whole lot of money, with being able to do it on your pace, on what you have available. There's an assessment on page number 8 of your guys' workbook that you can look through. The second reason is professional management, right? Having that professionally managed, somebody that's sitting behind the computer screen and actually watching the market and going through that process with you, to make sure that you're getting the best returns that are possible, depending on what the investment objective was and the risks and all that stuff. Flexibility and then diversification, be able to spread out that risk again. So there's a whole bunch of different types of funds. There's money market funds, municipal bond funds, income funds, balance funds, growth and income funds, growth funds, international and global funds, sector funds, aggressive growth funds. There's all kinds of different investments. Here's what I'm trying to say. Sitting down with somebody that could explain it to you in English versus what I call financial plannerese to help you to understand truly what you're getting. Because in all reality, it's not that difficult and it's not really as confusing as it seems. But sitting down with somebody that can help walk you through that process and help walk you through the proper types of investments for you and your family. So moving on to step number 4, managing your taxes. So not all taxes are equal. Most people don't realize this, but 60% of the federal income taxes are paid by the wealthiest 5% of the taxpayers. So those are people making over $248,000 in adjusted gross income every single year, or the wealthiest 5% of those households. So if we took a closer look at your taxes, if you looked at line 8A, you'll see something called taxable interest. This could be something on investments or the dividends that you're receiving, things like that. Could it equal out to a whole bunch of money, and you're going to pay an ordinary income tax on that. So let me ask you a question. Why are you paying taxes on income that you aren't using? This is going to your normal income tax rate. So rather than that, talk about capital gains taxes. So a short-term capital gains, you're going to pay at normal income. So if something's held less than 12 months, you're going to pay taxes on ordinary income, whatever your tax bracket is, both federal and state. Long-term capital gains are things that are held longer than 12 months. So in 2020, up to $40,000 in income if you're a single file, up to $80,000 in income if you're a joint, married filing jointly, you pay a 0% tax rate on long-term capital gains. Between 40 and 441 as single, or 80 and 496 as joint, you would pay 15% in capital gains. If you made over 496 as a joint filer, or over 441 as a single filer, you're going to pay 20% in capital gains. Other net investment taxes. So over 250, you're going to pay an additional 3.8% taxes if you're married filing jointly. So just know that taxes are not all equal, and it is dependent on income, and it is a progressive tax. So it does go up as you go into income. So let's look at some tax favored investments. Tax exempt investments are municipal bonds, Roth IRAs. There's also some tax favorability when we talk about insurance products, whether it's a life insurance policy and the cash value inside of it, or it's the death benefit inside that life insurance policy that has some tax favorability. Tax deferred would be things like traditional IRAs, your employer sponsored retirement plans, annuities have some tax deferral options. So if we're going to look at tax deferral, so if you're contributing to your traditional IRA, now, if you're under 50 years old, currently you can put up to $5,000 a year inside of a traditional IRA. If you're over 50, you get a $1,000 a year catch-up, and you can put up to $7,000 a year. So let's focus on that 32% tax bracket. That's an income tax bracket. If you contributed $6,000 to a traditional IRA, you would save yourself $1,920 in paying taxes. If you're over 50, you did $7,000, so you max it out. You would save yourself paying $2,240 in taxes. So what does that do? It actually lowers your overall tax, your income tax bracket, right? It actually lowers everything and allows you to save money on the taxes that you're going to have to pay to the government. If we were looking at something like a Roth IRA or a municipal bond or something that's going to earn money tax-free, on the top there you see the tax exempt yield, or what the tax exempt is paying. And if you look over on the left, you'll see where the tax income bracket is. So we're focusing again on that 32%. And we're going to go over to the 4%. So if you were earning 4% on a municipal bond or in a Roth IRA or something like that, if you were on a 32% tax bracket, you would actually have to earn 5.88% every single year, because remember that unearned income that you would have to pay on the slides a few before, you would have to earn almost 2% more to get that same tax equivalent yield. So make sure you're paying attention to your taxes. And again, working with a professional that understands that, working with a professional that's working for you, because every single plan and every single recommendation is on a case-by-case basis. So moving on to step number 5, saving for retirement. So let's take a look at the Smiths. The Smiths are currently 64 years old. They want to retire in 2 years. They currently live on $12,000 a month of gross income. So net income's obviously less after taxes. They want about $9,000 a month in income. Sources of their income are going to come from Social Security, 401k plans, personal savings and investments, and things that they have. Social Security between the two of them, if claimed at full retirement, which for the Smith is probably going to be somewhere between 66 and 67. Is going to bring them $2,750 every single month. Their 401k plans, potentially without running out of money, they could take $2,000 a month out of their 401k plans to not run out of money. Their personal portfolio is $450. If we are earning 6%, could generate $2,250. Now, again, 6% is not a guaranteed rate. This is a hypothetical. So a lot of questions, or a lot of clients that I sit down with, they kind of have this scenario where we have Social Security, we're looking at their 401ks, we're trying to figure out a way to potentially get them a guaranteed income to get them over that hump and get them to that spot to where they're comfortable and they could live, and that they have the income coming in that they need. But if we go through this process with the Smiths, their income that we could pretty much make sure that they don't run out of money is $7,000 a month. So they have a shortfall of $2,000 a month. This is common with a lot of clients that I sit down with. So there's some things that I'll talk to my clients about. Number one, retirement age. Looking at, can we wait a couple of years before you actually retire? Before you actually pull that trigger and stop working, can you wait a couple of years? Lifestyle. Are there things that we can cut out? Are there costs that we can cut down? Is there some debts maybe that we could pay off? Is there some things that maybe we could eliminate? Length of retirement is going to go with retirement age, but length of retirement, what's the longevity in somebody's life? And then income sources. Where's that income coming from? Does it make sense to maybe push out Social Security a little bit more so they get a little bit more income? Does it make sense to maybe move it into a product that's going to give them some sort of an income stream for the rest of their life? Don't know. But that's something that we sit down individually and talk to people about. I recently sat down with a client, and from Social Security, they're going to get about $1,500 a month. They only need about $2,000 a month to live and to survive. So I put together a plan for them with their assets that they had, with their portfolio that they had, that at 65 years old, by use of an annuity that I found, they could get $500 a month, which is 5 years from now, by the way. They can get $500 a month, which combats that difference between the $1,500 and the $2,000 a month paid. So there's ways to be able to do that, and that's something that we're able to work through with the process. So let's move on to step number 6, leaving a legacy. We really call this estate planning. So what could stand in your way of leaving a legacy? I don't know if you've ever lost a loved one, but there's a process called probate that is not fun. Probate is a minimum of 4 months. It's a public hearing. It could cost a lot of money. You have to have an attorney kind of walk you through the probate process. It could, the least amount I've seen was about $15,000 to $20,000. I've seen it be in the hundreds of thousands of dollars to be able to get through that. Taxes. Making sure that you file that last income tax return for the loved one. And then long-term care. There's ways to provide for long-term care by utilizing insurance, by utilizing certain things that you generally wouldn't be able to if you didn't have those things in place. Plus, most people will use their assets and end up drawing that all the way down and end up getting rid of everything, if you wanted to leave a legacy for you and your family. So probate, like I said earlier, is a very legal and financial process. It's expensive, it's time consuming, it's not private, it's public, it's put out in the paper. They want to have the opportunity for all debtors to be able to collect on any debts that they potentially could have. They want to be able to have that, and again, it's a minimum of a 4-month process to be able to get through that probate process. There's also federal estate taxes. If you live in the state of Oregon, the Oregon state exclusion is at $1 million. So if you have over a $1 million estate, there's actually some state of Oregon estate taxes that you're going to have to take care of. Currently, right now, in federally, it's $11.4 million, and that was in 2019. 2020 it adjusted a little bit, but it's pretty much the same rate. But understanding what those estate taxes mean, and then how do you make sure that you don't have to pay a whole bunch of money in estate taxes and working through that process. Long-term care, 70% of 65-year-olds will need some sort of long-term care services. I talk to, when I sit down with clients, I have a client of mine that I'm working with down in California, and part of the process that we went through was, hey, you have X amount of dollars. If something happened to you, would you have the kids take care of it? Would you want to go into a home? Would you want to go into a care facility where they take care of you, or would you want your kids to take care of you? I said, well, I'd really like to stay home, and I'd really like for my kids to take care of me. I said, fantastic. Who's going to cover the cost of their expenses and their living stuff and all that? And they went, I didn't think about that. So we put together a long-term care plan for them to make sure that the kids were taken care of when they had to come take care of mom. But 70% of 65-year-olds will need some sort of a long-term care service, and understanding all of your options you have available to you is very important. Cost of long-term care, national average is over $100,000. Are you prepared for that? Is your family prepared for that? Who's going to foot the bill? Who's going to cover that stuff? It's a big question. Estate distribution techniques that we go through, and again, we would refer you to a great estate attorney that is on our team that works very closely with us, that will be able to make sure that your financial plan and your estate plan talk to each other. It's important they speak the same language, as well as speaking the same language that your CPA wants to see, that your tax professional wants to work with you on. But there's wills, there's jointly held properties, there's contracts, there's trusts. Other estate documents, one of the important ones is the power of attorney. Making sure that if you're not capable of dealing with your financial stuff, if you're not capable of paying your bills and managing your checkbook and doing those things, you have somebody there that could do that. A durable power of attorney, a medical power of attorney. Who makes those decisions medically for you if something happens and you can't make those decisions for yourself? Who makes the decision to keep you on life support, or who makes the decision for a treatment if you're not conscious? Who makes those decisions for you? Well, having a medical durable power of attorney is very important. Having a living will, making sure that things are done in the way that you want, your wishes now, not when you're in distress. Different types of trusts. A testamentary trust will help control some of the distributions. It can help reduce some of those fees and taxes, but does not avoid probate, does not avoid that process. Having a living trust, though, can help control some of those distributions, can help manage those fees and expenses, and does avoid probate if structured properly and funded properly. So again, working with an estate attorney is very, very, very important. Make sure you have the proper things in place to have things go the way that you want them to go, to make sure that I have young children personally. I want to make sure that my young children are taken care of by the people that we want them to be taken care of. The state doesn't get to decide. We've decided that, my wife and I. So making sure that that stuff's taken care of properly and structured in ways that you want it to be taken care of. So those are our 6 steps to financial success. Again, we appreciate you being here this evening. So where do we go from here? Well, I would say you can do it yourself. There's all the information that I talked about, all the information on planning, budgeting, different types of investments, all the research. You can do yourself. You can go online, you can research all that stuff, you can do that. You can work with others. You can work with others locally, you can work with others where you're located around the nation. You can work with us. We have the ability to be able to work in all 50 states. So geographically, there isn't any challenges with that. Also with Zoom and everybody sort of understanding Zoom, geographical location isn't a big challenge. So working with us is an option. And like I said in the beginning, you get a complimentary financial plan. You get a complimentary consultation with us that our retail value starts at $1,000. So we're doing that complimentary by you just being here and joining us this evening. Or you could do what most people do and you can procrastinate. A lot of clients I finally start to sit down with, they're in their late 40s, early 50s. Some of them are in their late 50s, early 60s, and they procrastinated so long that now it's going to seem really expensive and a daunting task to get to that finish line, to get to that retirement finish line, things like that. So I always recommend that people don't procrastinate, that they get moving on a plan as soon as possible. We'll send you an email on what to bring and some of the information that we need, as well as a questionnaire that will help go through that. And again, I thank you for joining us this evening. If you have any questions, you can call our office. Number is right there on the screen, or you can email me at james@opfa.com. I'll be happy to answer any questions for you and schedule a conversation. Again, we appreciate you joining us this evening, and I hope that you got some value out of it.